If you've been watching US tech stocks lately, it's easy to feel like we're living in a loop. Big headlines, bigger valuations, and AI stamped on everything like a certification label. So the real question isn't whether AI is important. It's whether the stock market has priced AI in realistically, or whether we're watching a classic bubble form. To answer that, we need to be precise about what a bubble actually is. A bubble is not the same thing as stocks are up a lot. A bubble is when prices detach from underlying fundamentals and the story becomes the product. In bubbles, valuation expands faster than earnings, expectations rise faster than reality, and investors start buying because prices are rising, not because businesses are proving durable profits. So what does the data suggest in early 2026? Let's start with the strongest argument against the bubble narrative: earnings. A big chunk of the tech rally has been supported by real revenue growth and real profit growth, especially among companies selling the picks and shovels of AI, chips, cloud capacity, networking, and software platforms that businesses are paying for right now. BlackRock has argued that much of the 2025 tech performance was driven more by earnings growth than by valuation multiple expansion, and that multiples even slightly contracted in parts of the rally. BlackRock. That matters because it's the opposite of how many famous bubbles behave. In a classic bubble, fundamentals lag while valuations soar. Here, the fundamentals, at least for the largest winners, have been moving too. But that doesn't mean bubble risk is gone. It just means we need a more nuanced conclusion. Parts of the market can be overheated even if the whole sector isn't a fantasy. Now let's look at the strongest argument that bubble risk is rising: concentration and mega valuations. When a small number of giant companies drive a huge portion of index gains, it creates a fragile market structure. If those few names stumble on guidance, regulation, supply constraints, or demand, it can pull the entire market down, even if the broader economy is fine. And in early 2026, we've seen eye-popping valuation milestones tied directly to AI narratives. Alphabet briefly reached a $4 trillion market value on January 12, 2026. After news tied to Gemini and major ecosystem partnerships, according to Reuters. The same Reuters report noted Alphabet stock had gained around 65% in 2025, again reinforcing the idea that AI expectations are heavily influencing investor sentiment. Reuters. When multiple megacaps are hitting historic valuation levels, the market becomes extremely sensitive to whether AI monetization shows up fast enough to justify those prices. That brings us to the next key dataset: AI spending. One of the most important realities right now is that AI is not cheap. The market is watching a massive capex cycle unfold. Data centers, chips, power infrastructure, and networking. On a scale we usually associate with national infrastructure, not a software trend. Business Insider reported that Amazon, Google, Meta, and Microsoft posted record-breaking capital expenditures driven by AI chips and data centers, with Microsoft around $35 billion in a quarter, and plans for further increases being discussed across the group. Business Insider. This capex surge can support the not a bubble argument in one way and strengthen the bubble risk argument in another. Here's the bullish interpretation. Companies don't spend that kind of money unless customer demand is real. They're building because enterprises are buying compute, renting capacity, and integrating AI into workflows. Here's the bearish interpretation. If everyone builds at once, the industry can overshoot. Too many data centers, too much capacity, and not enough profitable demand, at least not quickly enough. That can compress margins, trigger price competition, and disappoint investors who assumed an uninterrupted growth curve. So the bubble question becomes: will AI demand grow fast enough to fill what's being built at profitable prices? Now let's talk about the most misunderstood part of this debate. AI monetization is uneven. Right now, the AI winners in stocks are often the companies closest to infrastructure and distribution. Chips, cloud platforms, operating systems, productivity suites, and ad platforms that can embed AI features into products people already use. The riskier zone is companies further out on the edge, those that need AI to become profitable in brand new ways, or those that have to acquire customers at high cost while competing against giant platforms bundling AI into existing subscriptions. That difference matters because bubbles often form when investors treat every company vaguely connected to the theme as equally valuable. In the dot-com era, internet became a magic word. Today, AI can play that role, especially for smaller companies with weak fundamentals. So what does the data say about the market's current mindset? Goldman Sachs, in a January 2026 outlook, points toward earnings growth as a core driver for markets and expects AI investment to keep rising, even if CapEx growth decelerates. Goldman Sachs. That suggests the institutional view is not, "This is a mania about to collapse tomorrow," but more like, "This is a multi-year build-out that needs to translate into earnings." But the same outlook also implies something important. The market is now demanding proof. In early AI hype phases, investors often pay for the promise. In later phases, they pay for results, cash flow, margins, durable demand, and pricing power. So here are the clearest bubble risk signals to watch, based on how bubbles typically show up in data. First, valuation expansion without matching earnings. If prices rise while forward earnings estimates flatten or fall, that's a red flag. Not because prices can't rise, but because the market starts paying more for the same profit stream. Second, narrative drift. When a company misses on its core business, but the stock still rises because it mentioned AI more times on the earnings call, that's not investment. That's storytelling. Third, CapEx to profit imbalance. If AI infrastructure spending keeps rising, but operating margins shrink and free cash flow weakens, investors eventually demand a payback timeline. The market can tolerate investment for a while, but not forever. Fourth, widening dispersion inside tech. When a few megacaps keep climbing but the average tech stock lags or falls, it can mean the market is narrowing. Narrow rallies can be strong, but they're also more fragile. And finally, the trigger that often pops bubbles, a change in the cost of capital. If rates rise again or credit tightens, high multiple growth stocks tend to reprice quickly. Even if rates ease gradually, the market has become much more sensitive to financing conditions than it was in the zero-rate era. So what's the conclusion? The data does not support one simple answer like, "Yes, it's definitely a bubble," or "No, it's all rational." What the data suggests is this: AI as a technology is real, adoption is real, and spending is real. The earnings case for key infrastructure and platform companies is stronger than many past hype cycles. BlackRock. But bubble-like behavior can still exist in pockets, especially where valuations assume perfect execution, non-stop growth, and instant monetization across the entire AI ecosystem. In other words, the most accurate framing in early 2026 is not AI bubble as one giant event. It's AI valuation tension, a market where the winners may stay strong as long as earnings keep proving the story, but where the most speculative names and the most stretched expectations are vulnerable to sudden repricing if results don't arrive on schedule. And that's the key line to remember. In 2026, the market isn't just buying AI, it's buying timelines. How fast does AI turn into recurring revenue? How fast does it turn into margin expansion? How fast does it turn into productivity gains that companies will pay for? If those timelines slip, bubble risk rises. If those timelines hold, the rally may look less like a bubble and more like a massive, messy, real-world build-out. One that still has winners, losers, and volatility, but is grounded in fundamentals. And that is what the data right now is really saying.